think in terms of what is required for markets to be predictable. What are the obstacles? Just to mention efficient markets. And yeah, without further ado, let me dive into the agenda and what to expect. So I have a bunch of topics with me. So first, I want to define predictability because, well, if I leave it just to the word, it would be a little bit too unspecified, too abstract. So I try to provide a definition that I can make operational later on, but it will be by no means the only one, right? And the question is, why does it matter at all? I mean, it should be clear. If you can predict markets, we all would be rich quite fast. Then I briefly want to review a few prediction methods used in the past beyond what I'm going to use myself here. Correlation versus causation here in this context, a very important topic. Also a brief look at the finance history and where we stand right now, and want to put into perspective topics such as efficient markets and passive investments. A brief discussion also of the role of mathematics in science and in finance in particular, and what is replacing math in many areas in the form of financial big data, and what role artificial intelligence plays. And I will conclude with a few very, very simple examples. So again, this is more like a discussion framework, which provides, I would say, lots of food for thought, but maybe not definitive approaches or answers. Yeah, predictability defined. What do I understand with regard to predictability? So we have a simple setup where we have a current point in time, let's say today, at this point in time. So doing a day at a certain time point, or we think just in terms of days, right, where we have certain points in time which represent history. They're represented here by negative numbers. We have 0, which is today, and we're going forward with 1, 2, 3, 4. This might be 1 minute from now, 1 day from now, or a week from now. I leave this open at this particular point, but it doesn't hurt that we think maybe in terms of end of day, for example, so daily time intervals here. So relevant previous, current, and future points in time. Then we have something like a price series of a financial instrument, right, where we have prices at every point in time t, right, assuming that there is trading for all these points in time. Or for short, we would write something like p minus 2, p minus 1, p0, p1. So simply, a financial time series, a price series. That's the starting setup. So from Wikipedia here, a definition of Markov chain or Markov process, stochastic model describing sequence of possible events in which the probability of each event depends only on the state attained in the previous event. So for a Markovian process, we would have that the distribution of PT only depends on PT minus 1. Right? For non-Markovian process, distribution of PT can depend on the history of prices. So for example, when we get into the area of derivatives, exotic derivatives, we have many payoffs that are path dependent. This would be non-Markovian. For many other quantities, you would assume Markovian processes. In terms of predictability, what I would say simply is that looking backwards in time, right, when I have something like this here, basically only p minus 1 would be relevant to predict p0. P0 would be the only relevant input to predict p1, right, for a Markovian process, and everything else that goes further back in time, further back in history, wouldn't make any sense to be analyzed in this context, right? So therefore, I introduced these concepts here quite early on. So to simplify things, however, I'm not primarily interested in the absolute price, but rather in the price change. So now already taking a bit of a machine learning approach, we can define binary features and or labels in this context. So we say when we have a positive change, dt at this point in time is 1, and when we have a negative change, we put it to 0. So this simplifies things not only from a modeling point of view, but I think it's much more easy, and it should be much more easy to predict just a direction instead of the magnitude of the movement, right? Magnitude of the movement is a real valued quantity, mathematically speaking, and to get this correct, it might be nice, it might be good if you could do that, but to keep things simple, again, we are mostly interested in the direction. So when I think in terms of day trading, right, if I have a prediction that the market goes up, I would go long. If I have a prediction that the market goes down, I would go short. So that's basically my set of actions in this simplified setting. So in that sense, well, we have a process of directional changes now, D, similar to the price change, where we have the time stamp, so to say, attached as a subscript, right? We get accordingly a process. The problem we want to focus on is whether we can predict the future directional change in price, D1, right? Well, we know the history of price changes, D0, D-1, D-2, D-3, etc. So taking into account, say, 5 historical directional changes, or a total of 2 to the power of 5, 32 patterns can emerge. So I will relate this to typical approaches later on. So when I draw just like random numbers here, for example, we see here such a pattern, right? This 1, 0, 1, 0, 0 is one of the 32 patterns. There is another one, 1, 0, 0, 1, 0. That's a second one from the 32 patterns. And the question is, when we now analyze, by whatever means, these patterns, can we somehow predict the next directional change, right? And you might say, well, this looks kind of like difficult, or it's impossible, but many people, thousands, if not many more on a daily basis, try to do basically exactly that, right? So we are now interested in estimating, and at this stage, I'm not kind of like in the business of naming a tool or recommending a tool or whatever. So in that sense, by whatever means, probabilities for D1 1 or D1 equals 0 here for any historical pattern. So we need to have some algorithm, some model, some whatever, where we have a look at the history and then try to come up with probabilities. Because in general, we are not like in the business of saying, I'm 100% certain that this will happen, right? It's more like, I think it's like 55% chance that the market goes up and 45% chance that the market goes down. So in that sense, we are mostly interested here in conditional probabilities, given a history that the market moves up or down, right? So we have maybe some, in this simple setup, in this binary setup, we have P and 1 minus P here as the probability. Very simple, traditional case. And from a machine learning point of view, this is what is called binary classification. So we just have to pick one of two that we consider the most likely thing to happen. Given a history H here, just one of two classes needs to be picked. So in that sense, given the probabilities that we somehow estimate, we pick the one to which we attach a higher probability, right? So sometimes when, I don't know, when I, for example, during teaching, introduce classification algorithm, easily the impression is obtained that they are really like absolutely clear-cut decisions, right? In terms of like 99% and 1%. To the contrary, so whenever we have a look at probabilities, usually we see that it's all but clear. So the algorithm have more like something like 50.1 versus 49.9 in that context, right? So classification is a special type of pattern recognition, and also falls in the category here of supervised learning in supervised learning algorithms in machine learning. Right, so now we are in a classical part of modern machine learning, right? So now predictability, according to Wikipedia again. So for teaching and talks, I like to use Wikipedia because everybody can just click and reference it. Not everybody has all the books out there. That might be nice, right? So predictability is the degree to which a correct prediction or forecast of a system state can be made either qualitatively or quantitatively. Right. So from Google, we have here the accuracy, and this is what we want to focus on as a metric, right? Here they say qualitatively or quantitatively. So we need some metric to measure predictability, and that's the accuracy for us for evaluating classification models. Informally, accuracy is a fraction of predictions our model got right. So we have the number of correct predictions over the number of the total predictions, the total number of all predictions, right? So these are two important concepts here in this context. So here you see the definition written out: accuracy, number of correct predictions over the number of all predictions. So we say that a process of direction and price changes is predictable, and I leave this here intentionally kind of vague if the accuracy of the predictions is significantly higher than 50%. Otherwise, you would be in the business of tossing a coin, right? Going to the casino, playing roulette and betting on red and black. If there's nobody cheating and the roulette table is kind of like in good order, in good shape, then it's 50-50 when we ignore the green zero. And we want to have something that is much better. How much better? This, yeah, depends, I think, on the use case and the market and what we want to do. But I simply write here significantly higher. Significantly can be 52%, can be 55%, but that's not the only thing that is relevant. We also need to get the right movements correct, not only the larger number of the directions. So why does it matter? So why is this an important problem? Why should we care at all? Yeah, here I have first the general answer. To be able to consistently predict financial price or directional changes can be considered the holy grail in finance, right? If you would have a machine that has 90% accuracy, well, we wouldn't care anything else, right? This would be like a surefire thing to get tremendously rich, right? So simulation analysis with real-world data shall illustrate the point. So here I simply pointed out, but just some simple calculations shall illustrate this point. So this is from my book, AI in Finance, chapter 14. So it's almost towards the very end, right? Where I use this example to illustrate the importance of that topic, right? So a number of regular imports, I download data. The data here is end-of-day data, and I use henceforth only end-of-day data. There's nothing kind of like in the form of tick data, intraday, 1 minute. It's just end-of-day data, which I use here, right? I go with the euro US dollar, right? And the analysis is for the years starting in 2015, ending in 2019. So beginning 2015, end of 2019. So the first strategy that I define here is a bull strategy, so a bullish one, where the idea is I go long and I stick to my long position throughout. So I usually call this passive benchmark investment. So here the hope is that the market here represented by the currency pair goes up. Well, we might know, of course, this is not probably the best strategy for euro US dollar, but I call it that way anyway. So I have then another strategy, the second one that I introduced, which is a random one, where I say, well, I simply take long and short positions in randomized fashion. So this could be considered like another benchmark in the sense of like tossing a coin is basically what decides which side of the market I take on, right? And a third one here, also a simple one, benchmark one, is a bearish one, where I simply go short. So we have like three, it's going long, randomized, going short, as three possible benchmark strategies here in this context. So now we get into the more interesting ones to make the point. Assume that the prediction model, whatever this is, we haven't talked about the model whatsoever until that point, gets the top 10% of both the positive and negative movements days correct. So this is like the idea, and there are many publications in this regard, in particular from asset managers that put out research that supports the point, which says, well, if a passive investor misses out the 10 best days over the last 10 years or 20 years, or has missed the 10 best days, so looking backwards, then the performance would only be half of what is shown. So in other words, if we miss the big movements, then we are losing out. So adding to my argument from before, the accuracy is kind of like one thing, but it can be even more important so to get the important movements correct, right? The big ones. I want to, in an ideal world, I want to be long when the market jumps up, and I want to be short when the market drops, when we see a crash, right? And this is modeled here that I say the top 10% of both positive and negative movements. And for the rest, I say the strategy, the model is not better than a random strategy. So I don't go into the details here of the code. The slides are shared. So if you want to repeat this, this is all self-contained. and you can execute this, because also the data set that I'm using here is hosted on my server, and you can, if you like, replicate the whole analysis. So the code implements it now for a flexible parameter t. So I can set t, as you see here, to 10%, 15%, right? 10% means that I get the top 10% and the bottom, so the worst 10% correct, meaning I'm long for the top 10% of the movements and I'm short for the 10 worst movements, the 10 largest drops. This is far-reaching, but again, we are here in a simulation to drive home a particular point, right? So now we have another point of view where I say, well, instead of like top 10 and worst 10 days correct, the rest random, I now say that I get a certain percentage value correct. Like from the outset, I assume, and you see it down here, that I get 51% correct, 60%, 75%, 90% correct. I don't go higher than 90%. That's already pretty high, right? I cannot emphasize this enough. And the rest is randomized as before. So we have now the data here in the data frame, right, where we have the long strategy, the randomized strategy, the bearish one, 10 top, 15 top, and here the artificial AFI stands in my book for artificial financial intelligence, right? And we see here with the 90%, 75, almost everything is now correctly predicted. So this is all theory. I'm pretty sure there's nothing out there which would reach these accuracy levels, actually, although I sometimes read it, but I've never seen something in real life which comes to these points. So here we are in a simulation analysis. So when I now translate these performance measures into cross-performance values, we see that the passive investment here for Euro-US dollar is minus roughly 7%. So I lose over the period of time when I simply go along the instrument. With the randomized strategy, I'm quite a bit better, right? So plus 24% here in this context. And I'm not discussing this on an annualized basis. These are cross values for the whole period of time. The bearish one is better. I mean, it's roughly the opposite here of the bullish one. So being bearish is better than being bullish. And now we get into the world of the theoretical simulations. All the other ones are, of course, easy and straightforward to implement, right? Even a random strategy is straightforward to implement. Of course, transaction costs here are neglected. So the first one gives me like 12 times. This is not 12%. This is 12 times. These are cross-performance values. So every currency unit invested gives me 12 here. 23, so from 10 to 15, it's a huge impact. 51, 60, 75, 90%, we see here 90-fold over 5 years. This is, of course, absolute exceptional. And therefore, I say, even when I read something, sometimes, and trust me, I've read this, that people say, well, we have 90% accuracy. Yeah, if you have 90% accuracy, this would lead to an explosion in your capital under management. That's simply unbelievable in the original sense of the word, right? So here we see the visualization graphically. So below here, these flat lines, basically these are the benchmark ones. When I zoom in a bit, and here we have the top 10. It's not like the ranking, so the colors will be the best, but this is clear. That's the 90%. When I turn this off, we get the rescaling. So that's the 75. This here is the 15. So that one, right? Here the 15 top. See the Hoover effect here. That's the 51. That's the 60. Yeah, here you see, for example, the 51 and 60. There's also an effect of randomness in there. So in this particular case, given that there is also some randomness, the 51 is even outperforming the 61 because the random allocation is performing better. And here's the top 10. So here's the 10 tops, and here's the 15 tops, and you see like the huge impact that the different assumptions have. So when I turn on the 90 get, so this is kind of like what is at stake. So if we have something that can predict future movements with say some 90% accuracy, that's actually what we would have in this context. So this is what is at stake, tremendous riches. So I should move out again. So how just checking, there is a question why I should focus, and of course you can answer your questions. If the question is more general in nature, we would probably postpone the answer until the end for the Q&A session. But this is here a technical question on the sign, a difference, and not on the returns. Yeah, because I want to simplify things, right? I cannot even properly talk about patterns and can enumerate the patterns when I would, for example, go with the returns themselves, right? And again, I mean, we can lead the discussion with regard to the features. Why don't we have floating point based features, right? And what is with regard to the labels? With regard to the labels, I think that's a valid design choice here to say, well, I'm only interested in the direction of the market and not in the absolute change, right? With regard to the features, it's an easy step to change to, let's say, floating point features in this context, which I often do as well. But here for the discussion, I want to keep things simple. The implementation part, it's easy to exchange than the features in this context. So how did people in the past try to predict the markets? And there are quite a few methods, but maybe first look here. Even for stock market prediction, you find an entry on Wikipedia, right? So stock market prediction is the act of trying to determine the future value of a company stock or other financial instrument traded on exchange. Again, for us, simplifying assumption, direction is what we're interested in. Right, the successful prediction of a stock's future price could yield significant profit, and we have just calculated what this could mean. The efficient market hypothesis suggests, however, that stock prices reflect all currently available information, and any price changes that are not based on newly revealed information, thus are inherently unpredictable. So others disagree, and those with viewpoint possess myriad methods and technologies which purportedly allow them to gain future price information. And this is what we now want to briefly review. I mean, that's like a large field, right? But over time, financial practitioners have used a plethora of methods in their effort to predict financial markets, among them fundamental analysis. So I don't know the exact number, but there's still like thousands of people around the globe who spend the time analyzing companies, speaking to CEOs, to CFOs, analyzing reports, doing peer group analysis, sitting in front of the Bloomberg terminals and gathering data, right? And then picking based on value growth or other fundamental concepts certain companies, right? Maybe leading to some trading or leading to some overweighting, underweighting compared to an index in this context, right? But this is all driven by the idea of active investment management or trading and not passive management where you simply mimic the index, right? Technical analysis. This is my best reference point, right? Because exactly what I'm here using as a framework allows us to be visualized here. Trend, support, breakout, statistical methods, regression, Bayesian methods, whatever, or time series modeling, ARIMA, arch-gauge for volatility primarily, but so many time series models as well. And these days, of course, artificial intelligence, machine learning, deep learning, reinforcement learning, all these are methods, right? And I have a simple example here for the technical analysis. This is when I do trainings, teaching, this is my go-to example because it's so simple, everybody understands it. When people for the first time see Python, I try to keep the examples as simple as possible. And here, working with two simple moving averages, going long when the shorter one is above the longer one, and going short, vice versa, right here, visualized. That's a typical case, right? Here, blue is above purple, long, blue is below purple, short. So that's a typical technical strategy. But there is, of course, I don't know, innumerable such strategies, ideas, cases, right, where people use whatever Bollinger Bands, RSI indicators, MACD, etc. pp. Here you see a typical pattern type of thing where people say, well, whenever you see a bearish head and shoulders or a bearish rising wedge, etc., then this is a sell signal, or any other thing is a buy signal. So the inherent assumption here is indeed that people are dealing with non-Markovian processes, right? We have introduced a definition, right? For a Markovian process, the history and any type of pattern should be irrelevant. And this was also part of the definition. Before I said, well, if markets are efficient, then just today's price is relevant. But all these approaches contradict basically the idea of a Markovian process of efficient markets, right? So they say, well, the history plays a role. Right? The market behaves predictably based on certain patterns, here continuation, reversal patterns that we can spot in the markets, right? And yeah, what I was saying before, it's not only thousands of analysts around the world who do their daily job, there are also thousands of traders, day traders, etc., that at least in part rely on such price formation, on technical ideas in order to come up with trading investment decisions, signals, and then accordingly the decisions. So an important concept that we need to add to the story is the difference between correlation and causation. I think basically it should be clear, but to me, for example, I just recently read the book of Why, which is basically concerned with this topic and this topic alone for a whole book, and it was really revealing to me. But I don't want to go into like the many important aspects that are covered in the book, but just one particular example. And we have in the financial world many stylized facts that are related to correlations, right? So there is some stylized fact about financial markets which shows stable non-zero correlations over time, but which we cannot, and that's the basic message, exploit in terms of causation, right? And here's the case of the well-known case of the S&P 500 and the VIX volatility index, where we can easily derive that the two of them are highly negatively correlated. So with minus 0.8, I mean, this is really a high non-zero correlation, a negative one, right? So we see this here visualized. This is the scatter diagram of the returns of the VIX returns as plotted against the S&P 500 returns. And you see basically here the negative slope, also an indicator for the correlation. Not directly transferable, but one visual way of showing the correlation. And when we have a look at all this over time, and this is what I meant by stable, it's not only that this is the average for a relatively long period of time. You see also when I go in slices of 1 year, here 252 trading days, the highest value that we see is even lower than minus 0.7. The lowest value is minus 0.9, and in between, it changes over time, but it is stable in the sense of being negative and highly negative throughout, right? You see more or less here the best fit line has a slope of 0. So this means that it stays here constant, right? But now the difference to causation, I could come up with the idea and say, well, maybe the VIX is leading the S&P. And so whenever the VIX changes, I position myself in order to benefit from changes in the S&P 500. But what we see here is that they are correlated when I shift them by 1 day. So yesterday's VIX change is used here compared to today's S&P change, right? So VIX, we try to use VIX here as a leading indicator, but we see it doesn't really serve as a leading indicator because there is basically 0 correlation. And we see that the 0 correlation is more or less stable over time. So we have here highs, short period of time above 0.2 and lows for a short period of time below minus 0.2. But overall, again, we have here on average a 0 slope and only a very basically negligible ordinate value here for the best fit line in this context. So this doesn't work. So we cannot use the changes in the VIX as predictors or indicators for the future change in the S&P. And the same thing holds true the other way around. So I could say, well, if the one is not leading the other, maybe it's simply reversed. And here I use the S&P 500 change from yesterday versus the change of the VIX today. And you see it's basically the same, slightly higher, but still pretty close to zero. And here we see it also here it doesn't even reach 0.2 nor minus 0.2 in this context. So a strong negative correlation, and it is stable over time, but in terms of causation, so using one as a leading indicator for the other simply does not really work. So we have a big difference here. Correlation might be nice to observe and to know about, but it hardly ever serves as good indicator. So when we now have a look, and I've just included this so that we might have a look at where we're coming from or where we go to. It basically all started here with Markovit's portfolio theory in 1952, here with the classical period. So my new book coming out in, I think, 2 weeks, Financial Theory with Python, focuses on the classical finance part based on Python, right? Many examples. This is where math, so to say, was introduced to finance. In the modern period, we have had many advances on the mathematical side, but primarily also on the numerical computational side. My book, Derivatives Analytics with Python, focuses primarily on these advances, right, with regard to option pricing. But where we are today, we are in the computational period. So we have left basically the wonderful times of mathematical dominance in finance, and numerics have taken over in that sense, or I should rather say a theoretical dominance compared to numerical methods. And now we are entering the period of artificial intelligence in finance, where we have completely different methods suddenly available and applicable as compared to, let's say, traditional econometrical methods, such as ordinary squares regression, right? They have their limits, we all know that, and maybe AI here is to the rescue. So just a brief review of efficient markets, not going into the details here, but just here focusing on the later part here. This theory casts serious doubt on many other methods for describing and predicting stock price behavior, methods that have considerable popularity outside the academic world. So, for example, we shall see later in this article, right, if the random walk theory is an accurate description of reality, then the various technical or chartist procedures, we have seen them, right? Technical, like simple moving averages and price formations, chartist procedures here for predicting stock prices are, and now comes the conclusion, completely without value. So if markets are efficient, what so many people, many thousand people around the world are doing on a daily basis should be basically worthless. That's a pretty harsh thing. So a bit more modern here, the definition of efficient markets. The other one was related to random walks, pretty similar, but not exactly the same. A market is efficient with respect to an information set S if it is impossible to make economic profits by trading on the basis of information set S. And here it's important, economic profit. So in my book, AI and Finance, I have one part which is focusing on statistical inefficiency. So that's the starting point. And the second part is, once I've discovered a statistical inefficiency, I need some trading strategy, some approach to exploit my statistical inefficiency in the market based on some concrete strategy, right? We can do as much analysis as we like. If we don't find a way to exploit, to benefit from what we have found, then it's a hard point. Therefore, economic profits, that's kind of like the important aspect here, not some theoretical edge in terms of accuracy. So we have the weak form, semi-strong form, the strong form. The weak form just focuses on past prices, price data. This is what we are focusing here as well, primarily. Semi-strong form includes everything else, like stuff that is in reports, news, or whatever. And the strong form, which is unrealistic from my point of view, is that everything, even if it's just in the possession of a single individual, so let's say the CEO, should be reflected in the market. So today, with regard to prices and other data, news, etc., fundamental data, the mechanisms are clear. So we have APIs, we have programs that access the APIs, that process the data, and in many cases, trading happens already algorithmically, taking into account the data, the prices, etc., that is available. So even if these theories have been formulated a long time ago, when all these mechanisms haven't been available, I think we now have a clear technological idea and understanding of how this indeed might work in the real world, right? So also here, the Markov property of stock prices consists with a weak form of market efficiency, right? Market efficiency, Markov property. This states that the present price of the stock price impounds all the information contained in a record of past price. If the weak form of market efficiency were not true, technical analysts could make above average returns by interpreting charts of the past history. There's very little evidence that they are in fact able to do this. So this is all in the same spirit. So I have here an example. Time doesn't allow to go into the formal example, but in the slide deck, you have the code available and you can look at it. Just a very brief look here at passive investing and index funds. So one conclusion that people draw from efficient markets, and if they trust in efficient markets, is that analysis, costly analysis and intensive analysis of past prices, of fundamental data, of whatever, of competitive comparison, peer group analysis, whatever, doesn't pay, right? So the current prices simply reflect what is to be learned from any kind of source, right? And we have here, this is an article, December 2020, Financial Times. I like the title, A Theory of Almost Everything for Financial Markets. And you see here, it is true that the indices that passive funds track have over time morphed from being supposedly neutral snapshots of markets into something that actually exerts power over them, thanks to the growth of passive investment, right? This is kind of like the more people believe in passive investing in efficient markets, the more people invest in passive funds, ETFs, etc. The more self-reinforcing, self-fulfilling these processes become, right? So the more money index funds garner, the better their holdings do in exact proportion, right? This is the self-fulfilling, self-reinforcement thing. So when you say, well, if enough people believe in efficient markets, then markets will become efficient, right? Because simply the stock indices are mimicked. So pretty interesting thing. And you see here the growth in passive index, right? Index fund universe here sorted by asset class, right? This is where we see the growth over time. There was just one dip here with regard to these investment vehicles during the 2008 crisis, right? And here a small tiny dip, 2018. So mathematics and science, also a topic that I love. So here, how beauty leads physics astray. This is not related to finance, is related to physics, and I like this book. I just recently listened to it as an audiobook, also of the print version. They were so sure, they bet billions on it for decades. Physicists told us they knew where the next discoveries were waiting. The experiments didn't reveal anything new. What failed physicists wasn't their math. So we are here in physics, and when they talk about billions, right, this is when they build like large holodron colliders and the likes, right? It was their choice of math. Right, so here that's the conclusion, or the conclusion during the introduction. They believed that Mother Nature was elegant, simple, and kind about providing clues. They thought they could hear her whisper when they were talking to themselves. Now nature spoke, and she said nothing, loud and clear. So the argument of the book is that physics got astray, indeed, due to the overuse and misuse of mathematics. And I think in finance we have that as well. So we have many theories. Many a little bit older, driven by elegant math, but not really of value in the practical world, right? So here's one example, and it's a paper by Farmer French, 2004, about the capital asset pricing model. The attraction of the CAP-M, and this is one of the most widely used models, maybe not in finance, but in many other areas like accounting and M&A for capital cost calculations, etc., is that it offers powerful and intuitively pleasing predictions about how to measure risk and the relation between expected return and risk. Unfortunately, the empirical record of the model is poor enough to invalidate the way it is used in applications, right? Here, the version of the CAP-M developed by Sharp and Lindner has never been an empirical success. The problems are serious enough to invalidate most applications of the CAPM. But there are even like, partly laws, like in Germany, when you sell a company and you need to derive in a market-based fashion the value, fair value of a company, you're supposed to use the capital asset pricing model to derive weighted average cost of capital. But the empirical support in the markets is not good. And for privately held companies, it's even more questionable whether this makes sense. So data to the rescue, right? So I need to speed up a bit in terms of time. Data to the rescue. We have seen in many, many other areas that data has proven effective where simple theories, have been lacking or simply not, being available or not even being able to develop. Let's say here in language, right? Natural language processing got major breakthrough through to the availability of lots and lots of data, text in the web. Or on the web, right? You have billions of websites and you can crawl the web and you can learn about language, quote unquote, for free, right? Also with regard to videos, etc. We simply have all the data available. And maybe finance might be a discipline where, contrary to many successes here in physics, like F equals ma or E equals mc squared, right? One of the most famous equations to have ever shown up here on planet Earth, right? Maybe we also need simply data and cannot rely on simple theories. That's kind of like the idea here. And maybe the big financial data in combination with artificial intelligence, and here I'm not going into any details. So many details, also Python code and examples, etc., are discussed in my book, Artificial Intelligence in Finance. But the basic message is, if we rely on big financial data, which is available today, and add artificial intelligence to the mix, we end up at AI first finance. Meaning that we have entered a new area, and you recall like the 5 periods in finance that I mentioned before, from the computational one, now entering the AI first finance area, where we have the data available, we have the hard software, the technologies, and the artificial intelligence methods, algorithms, to have a completely different look at finance as compared to what we had before. So last but not least, maybe some 3 minutes, a quick view at how we can use machine learning given the framework that I've introduced first, right? Meaning the prediction of directions in the market. So not going into the details here, I go with Goldman Sachs stock price, and we assume that there are persistent patterns in financial markets. So this is in spirit of the technical, the chartist traders, the day traders that have a look at the chart and look at the history, right? And say, well, there is persistency in certain patterns. They allow me to predict future movements, right? This is in contrast and not in spirit of efficient markets or the idea of Markov chains with regard to financial prices. So we assume binary features and labels only, exactly the setup that I introduced first. So here is the code to create lagged data, right? And we have here just a very simple case, 2 lags, right? So I only have 4 patterns, just like 2 to the power of 2, like 4 patterns. I think the most simple case to get started talking about patterns. And down here, maybe I increase this a bit. This is just like the data that we get. We have the return, we have the direction. This is the labels data. And here we have just like 2 features, 2 binary features. I now go not with 0 and 1s, I go with 1s and -1s for positive movement and negative movement, right? And the question is now, is there something to the pattern 1 - 1, right? Is it more likely that the price goes up afterwards, or is it more likely that the price goes down afterwards? So that's a very simple case. Most simple, maybe too simple, right? So I do divide the data into training and test data. And what I do now, I take a frequentist approach, no machine learning whatsoever, just like counting, no sophisticated algorithm. And the results are shown here, right? So when I say, is it more likely that A or B happens? Here you see the number of the pattern itself, -1, -1. This pattern, right, leads to a down movement 212 times and leads to an up movement 231 times. So the percentage here, the probability, the frequentist probability for an upwards movement is 52%. If we have observed -1 and +1, the probability for an upwards movement is 54%. So here we have a special case. I skip over that. And then you see here the two other major cases, 1 -1, 1 +1. Here it is pretty close. So it's 50% and 49%. So this might look more promising than the part below. But this is a simple frequentist idea where we talk with simply numbers and count them and build ratios to estimate probabilities based on a frequentist approach. But we have machine learning to the rescue here. 5 legs now. This makes exactly the case from before. 32 train and test data is now that I go with. And I import a decision tree classifier standard method. I instantiate the model. I train the model here on the train data. The accuracy on the training data set is 55%. The accuracy on the test data set, which is the important measure, is just 48. So we can learn about the train data set kind of okay-ish, I would say. But on the test data set, we are below 50%. So given my oops, so this is like a live Jupyter notebook, so I can edit the code and execute it here. So here we are not successful. Now support vector machine, another one. Training, accuracy score on the training, quite a bit higher, 56.8, but on the test data set, not that good. And the same here for something more elaborate here, a deep neural network, MLP, classifier. This is a multi-layer perceptron from scikit-learn, quite powerful and highly parameterizable, 55 and 46. So given the question that the title raises, the answer here probably would be no. But again, I just thought I provide a framework. I don't provide an answer. So being able to predict the markets is kind of like the holy grail in finance. People around the world on a daily basis, minute by minute, they try to beat the markets and to overcome the efficiency in the markets, right? There might be correlations, stable over time, but causal relationships are pretty hard to identify and exploit. Efficient markets seem to have strong support, which is against the predictability, right? And while mathematics and normative ideas dominated finance in the past, we now enter a new world where we have lots and lots of data, big data, and can apply AI accordingly. And maybe, and this is like my thinking here, AI, machine learning, deep learning might open a path to identify and exploit statistical and economical efficiencies in financial markets, which haven't been open before. Yeah, that's my conclusion with regard to the talk and the framework that I wanted to present. Now, I think we have still a little bit of time for questions.
Yes, guys, I should have mentioned in the very beginning of this talk that there's a Q&A button in the bottom, and you can post your questions into the chat. And in the meantime, actually, I myself have a few questions for Eve. Well, I was thinking just for a moment, if we think, because both you and I are actually quite dependent on the ability to predict markets. So let's just leave the conclusion that it's very hard to predict them. And you brought up a very topical subject of practical accuracy of the prediction. So given your experience, I'm sure you've been working with different asset classes, like right from commodities to Forex to stocks to maybe indices, like different types, where you think you can see some predictability, and what would be the practical statistic for the accuracy, like in your personal professional experience?
Yeah, it's difficult to say. So from my experience, given the analysis that we've done over the years, is that mean reverting quantities such as currencies or commodities are slightly more easy to predict than trending like stock instruments in this context, right? For example, if you try to predict something in terms of like how I presented it, and you want to derive a trading strategy, let's say for the Apple stock or the Amazon stock over the last couple of years, they are mostly going up, right? What strategy shall kind of like give you an edge in this context if you have strongly trending quantities? Therefore, mean reverting quantities, I think, might prove a bit more fruitful. In terms of accuracy, again, it's not the accuracy alone. I try to stress the point that it's also like the type of movement. So many movements. This is like the stylized fact that you have typically log return distributions which are highly peaked around 0. So we have many movements which are close to 0 on an end of day basis, right? And if you get many of these correct or wrong, it doesn't really hurt, right? We need to get the tails correct and wrong. And therefore, that's kind of like the difficulty to get the larger movements correct. And since they are usually driven by some exceptional event, right, it is to question whether there is some mechanism to train a model to get the prediction correct. So let me cast it another way. So people often ask me, how do you train a machine learning model to predict a market crash? By definition, a market crash is a rare event, is an extreme rare event. Usually we don't have enough data to train models in supervised version to predict rare extreme events, because by definition they are like black swans, rare extreme events. And this is where I see really the difficulty. But if you get it correct, like, you know, with like a good accuracy, and you get the little bit larger movements, right, then you should be on the good side in this context.
Yeah, I have some questions in the end, but there are a few more questions from the audience, so maybe I'll let you address those for now.
Yeah, there's one question with regard to what I think about the recent book, The Man Who Solved the Market, how Jim Simons launched the Quant Revolution. Yeah, a pretty interesting read. What you read in that book, that over time, Renaissance got or had a hit ratio. This is accuracy with regard to a statistical prediction. Hit ratio is with regard to the trades that were profitable. And the hit ratio was just slightly above 50%, like 50.02, right? You would expect maybe from the most successful hedge fund ever that they have some hit ratio, I don't know, 60, 70%, I don't know, right? But this was for me one of the revealing quantities related to your question with regard to what is a good accuracy. The one thing we were talking about statistical things, the other one, of course, is how many trades you get correct after transaction costs, etc., right? This is also the problem with tiny little movements. Even if your model gets tiny little movements correct and you change position, transaction costs might eat up everything that might be a potential profit without transaction costs. Right? So with regard to cryptocurrencies, I'm not involved. I'm honestly not a big fan. Many people who know me who know that I'm not cryptocurrency. So for example, Bitcoin is driven by so many different things. You know, when Elon Musk is able to move the whole crypto industry, and then things like Dogecoin and the Bitcoin itself, it's difficult to have the approach that I have just shown to something like that. So there's a longer question. Let me read it. Using price history. What about other data here? Yeah, there's. I just focus here on a very simple case on the historical.
Sorry for interrupting. You might need to read it aloud to other people because.
So the question is, what about other data set as predictors for future prices, right? So I'm just working with the historical directional patterns, right? Of course, you can include anything. Maybe you can include all the statistical things, for example, that people use for technical trading. This is easy to do. Everything that is price series related is pretty simple and straightforward. We have implemented, for example, back then for Dow Jones, even a real-time indicator for, in this case, it was Bitcoin, but it was based on sentiment analysis of all the news cryptocurrency related. Of course, just the imagination today is the limit. And what I like to say is that the feature engineering, that's the hard part, right? I'm not saying that machine learning replaces proper research and hard work in this context. The hard part is coming up with the right features, which somehow have at least stable correlations, predictive power. If not, and that would be the important step to the holy grail, a causal relationship, right? that's the hub, that's the research. This is what people are focusing on, right? To figure out which ones are really valuable in this context. There's somebody asking which book I would recommend to explore the topic. Yeah, this topic in particular, I have shown the book AI in Finance, but it's for a beginner, maybe not the best book. My book, which is now coming out, Financial Theory with Python, that's the book for the, I would say, absolute beginner. Starts with finance from scratch, starts with Python from scratch, and then you can move on to Python for Finance, which has a bit of that stuff in there, and maybe later on you can then, after you have leveled up your skills, move on to AI in Finance. If you don't want to do hardcore coding and want to read more about it, you can for sure pick up AI in Finance as well. Right? There's, I think, lots of text beyond the code itself. Yeah, thanks for the nice words. Somebody's asking whether I find the MLP classifier and scikit-learn to be good enough. So I'm personally, as you might know, I'm mostly in the training business. And of course, we need to teach the standards. And we also teach, for example, TensorFlow Keras with the Keras front end, right, where you get much more flexibility in terms of your deep neural networks. We also teach reinforcement learning for finance, also recurrent neural networks such as LSTM in this context. So MLP classifier for me is usually the starting point because it's off the shelf, out of the box, easy to use. But with TensorFlow Keras, you get like the whole world of deep neural networks at your fingertips as well.
I'm conscious of time, but actually I have one last question. You know how most of us are now in the benchmark business, and we evaluate on our performance versus the benchmark. Do you think it's easier to forecast movements versus the benchmark, because then you probably wouldn't have this problem of tail effects?
Yeah, this is, I mean, I recently got more and more involved in the asset management business, where I also teach classes where you can use these approaches here to, in an integrated way, for example, predict returns. In that sense, also relative performance of constituents in an index, right? Which you can then use as input for your models to optimize, right? Use, for example, with Black Litterman, where you can consistently apply your return forecasts and correlations into such a model, where I think there are some good indicators that this might prove useful, because you have here effects that are really like in a portfolio context, not as harsh, to put it that way, or you have, how shall I say, since you're dealing with a larger number of assets, the overall result is not as dependent as like a single instrument trading strategy on your forecast, right? It's more like that you get the relative forecast correct, and this might be a much easier undertaking indeed, as like to predict for one single instrument next day's movement, right? When you predict the relative performance of a whole, let's say the German DAX 30, what it was, or DAX 40 now for me as a German, in an integrated way, right? But this is possible. This is something that we do as well, and teach as well.
Okay, actually, we run out of time, and we even just a little bit over time. I just want to say thank you so much for participating today. It was a huge pleasure and honor to have you here. And thank you to all the participants to join this call, and the recording will be available on the website. Okay, have a great Thursday. Thank you so much.
All right. Bye-bye.
Bye-bye.